Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to three titans of the investment world, namely Justin Urquhart Stewart, founder at Regionally, Martin Gilbert, chairman at Revolut and Assetco, and last but not least, Chris Watling, founder and CEO of Longview Economics. So welcome, gents.
Welcome. Good to be here. Thank you.
Yeah, well, Chris, perhaps we could start off with you. Given the sort of like rising investor concerns over inflation, the flattening yield curve alongside sort of like slowing economic data, plus actually the S&P has fallen again this afternoon. What's your sort of view for the capital markets in 2022?
I think the outlook's reasonably good. I mean, it's not going to be as easy as it was last year. I mean, you'll be aware the S&P was up, what, 26, 27% last year. That's pretty gangbusters. But the idea, just because you've gone up 1 year, well, you're not going to do the next year is not true at all. I mean, you often get 4 or 5 year strings of very good years for global equity markets. So, yeah, the Fed's tightening, but I think the real theme out there that people need to get a hold of, and I think this will be the theme for 2022, is we're moving from the end of emergency policy to kind of towards normal. We're not going to tight territory. There's abundant liquidity still out there, and really what the Fed's doing is just catching up with where they should have been, you know, maybe 12 months ago. So it's good. I think there's still plenty of support out there, policy support for markets. The trend is up, and the global macro, the global economy is going to expand fantastically this year, and it looks like a pandemic's going to become an endemic. So what more could you ask for?
And your bird's eye view, Martin, is that sort of like chiming with how you're seeing? I mean, you've obviously got your fingers in many pies in terms of asset management and the miners and obviously, you know, all the sort of the retail side. But what's your sort of view about the economy and capital markets?
Yeah, no, I agree. It's I think it's pretty healthy going forward. You know, Asia looks okay. China's obviously slowing down a bit. India's still okay. There's nothing there that's surprising markets. Property, obviously the property sector in China is going to be difficult. As I say, China slowed down a bit in the second half, but still for most of us, you know, 4.5 to 5% growth would still be pretty good. So yeah, no real surprise out there. Healthy corrections, I think, in the US market. So yeah, I think it's okay. I mean, it still looks high, but where else are you going to put your money but equity markets?
Yeah, what's your
UK looks good. I'll leave it to the UK experts, though.
Yeah, okay. Well, moving that to you then, Justin. What's your sort of view of the equity market? But maybe also contrast it a bit with the bond market, because if we're saying that we've got rising yields, it's going to be a bloodbath on fixed income, I guess.
Oh. Yeah, I mean, it's going to be very nice. Remember, we've got an entire generation of people now who have never seen inflation, let alone double-digit inflation. Some of us around this table are old enough to remember 25% inflation in Britain, which was looking positively Brazilian at that stage, wasn't it? Although I think Brazilian inflation was about 100 and something around at that stage.
Or Turkish.
Or Turkish. There's a basket case. So, but the point is that you've got some factors coming through that I think some of the traders aren't really very used to. How inflation's, what it's going to do. And the question with inflation is it embedded, or is it just 12 months drop off, we get rid of the gas, the oil price rises, and it'll come back? And the answer is it's a bit of both. There will be a pull off, but there seems to be a little bit more embedded stuff in. I'm looking for America here to give us some guidance on it. So look for, straightforward, make sure you've got equities which can absorb inflation, use inflation, and aren't actually finding themselves being stuck with it. And of course, the fixed interest market is going to be really difficult like this because it's the sort of returns you're going to be getting pretty small, and I think the risks you're going to be seeing there are going to be pretty unpleasant, unless of course you've got linkers, and that'll actually give you some protection for that. But overall, Martin's absolutely right. Where else are you going to put your money at the moment, for God's sake? And you've got, considering what has happened over the past 2 years, we had a global financial coronary. Actually, the global economy is growing pretty well. So that's quite encouraging stuff. Yes, there are things that domestically in the UK are going to be impacted. We've got the tax rise coming through, we've got the end of the price cap on gas, all those sort of elements. So domestically, it's going to be a squeeze in the UK, but they are very localized things. And I think the UK economy has got some really, I think apart from the, it's the message that UK is putting out at the moment Not quite sure if they've still got a prime minister as of today. So we're giving out every impression to the rest of the world, invest somewhere else because I can't quite work out what's going on for the time being. That'll pass. I still think now we're going to be seeing a lot more volatility coming through, which I like, because we've still got good quality assets, and if you buy good quality assets at a discount, then, and it always comes back to this issue when people say, should you be selling out of the market? I always find the only time I tend to lose money is when I'm out of the market. And you tend to miss out on what seem to be rather good ideas. Always keep some cash available to use for that. But actually, for longer term investors, good quality equities, good, the benefit of the compounding, keep that mantra going. Otherwise, you try and be too clever for your own boots and trying to time the market. The phrase, of course, it's time in the market, but it does apply.
I was going to say, actually, Paul, in addition to that, the most fascinating, I think, move in markets this year, I mean, we're only 2 weeks in, but there's a very clear rotation playing out globally. And obviously tech globally is getting hit hard. The mega caps, we've all seen that, the disruption of Wall Street. The Goldman Sachs quote that there's more selling in mega cap tech stocks in week one than they've ever seen through their prime brokerage. And on the flip side, if you look at the FTSE 100, I think it's up for this year. It's certainly held in very well. It really hasn't had many down days of any significance. So the rotation is happening globally to favour, I think, what Justin was just articulating. And forget the politics. I mean, it doesn't really matter if Boris is prime minister or, Rishi. I'm confusing him with what I had for lunch. I apologise. Or any of the other players. That's not really the point. The Tories will be in power.
Yeah. So I would, I tend to agree in terms of you've seen a rotation not only across sectors from sort of like high tech into expensive high tech into more value orientated sort of financial, but also getting it regionally from the US, which I think is on a 21 times PE multiple compared to the UK on about sort of 13 times. But Chris, I mean, obviously we've started the year off as sort of like a bit of a year of the banana skin, actually, with Boris, as Justin pointed out, slipping up, and but are the central bankers going to slip up? I mean, that's the sort of my concern is such that if you've got rising inflation expectations, they're going to tap the brakes too much with rising interest rates, and if that occurs, how is the curve going to flatten potentially? Is it going to invert? Because that could really drive returns.
Well, I think that's a really good question. I would say that the markets that was the theme in the last 6 months. What we've really done is priced in future rate hikes. That's what the markets have done. And they've probably gone too far. And I think what we'll see in the first half is inflation surprise to the downside. So actually the pressure come off central bankers to pick up the pace of rate hikes. So I think that's going to be great for equity markets, because if you start pricing out a little bit of those hikes, not a lot, but a little bit, in other words, we've overpriced in hikes, then it eases the pressure on equity markets and allows them to flourish. So I like what's going on at the moment. And I think in that kind of scenario, inflation's slightly softer than people think. Just look at Baltic freight rates. They've come off dramatically in the last 3 months. There's lots of leading indicators that suggest that the inflation pressures are easing. And that'll be good for markets, and that will steepen the yield curve. So it'll actually favour the UK market over the US and other global markets. So I think that's the thing to watch. The theme for the last 6 months was pricing in future rate hikes, moving towards tightening. It's now coming through from the central banks, but we won't be pricing in to the curve any more rate hikes. And markets, of course, are forward-looking, and that's what matters.
Yeah.
And also remember that the interest rates going up actually can be seen also as a positive sign. Because remember, we're on emergency rates at the moment since the banking crisis. We need to get back to something which is more normal, and it'll take time to get there. There's no rush for it. But the policy idea of sort of saying, look, we can raise rates without actually causing a panic. The cost of money is still going to be pretty bloody cheap, but central bankers want to have rates a little bit higher. So when there are problems, they can't afford to cut them. It's bloody difficult to cut them, but they're at naught. The background is actually it's the global economy has been repairing itself. And I'm very impressed by actually how resilient it has been considering what's happened. And I see no reason why any of that should stop. There'll be geopolitical issues getting in the way of things like that, and Russians waving their guns around and things, but that's normal news.
Yeah.
Look at the corporates. My one concern over the corporates is with the inflation element, particularly looking at some of the UK ones, is actually their margins being squeezed. And it's what I'm finding fascinating now. Those companies that can put prices up are doing so. Get that news out the way. When everyone else is doing it, do it as well. Because you don't look like the outlier 6 months later.
Martin, what's your sort of view? If you have a sort of like a rising interest rate environment, and you have sort of like commodity prices coming off, softening off, what's your view for the miners and the sort of the commodity plays? What you're seeing at the sort of coal face with, I mean, obviously there'll be Rio and there'll be BHP and Glencore and people like that.
I think the interesting thing from an ESG angle has been that the investors now think that these legacy assets like coal and oil are best held by listed companies rather than spinning them off. So that's been quite a big change in the sector. People who were wanting the oil companies or the Glencores of this world to divest of these assets have changed. The Anglo sale of the coal division, where they immediately turned around and then said, well, we're going to start mining for coal again, changed the changed things. But certainly I think commodity prices will soften, but the profit forecasts at the moment on spot prices for the commodity companies is unbelievable. How much money they're making, how much cash they're generating. And as long as they don't make the mistakes in the past of investing in huge capital expenditure projects, they look really, really good investments at the moment.
And does that chime also with the energy sector? Because I saw in the S&P 500, when they've done their split for 2022 and they look at sort of analyst buy and sells, the most favored sector now, even though with the backdrop of ESG, is oil and gas. Out of all of them, it's higher than tech, healthcare, all the other sort of like the green or perceived cleaner types of sectors. Oil and gas is the #1 sector by analysts by S&P. What's your sort of view on that, Martin?
Yeah, no, I mean, coal would be the same. I mean, if there were pure play coal companies in the UK, there's one in Australia, Whitehaven. You just need to look at the share price. But certainly having a house in Aberdeen as I do, I think the astonishing profits that oil companies are making at this sort of $80. I think the interesting thing in Scotland, especially in the northeastern Scotland, is the bemusement that we should stop exploring and import oil and gas has caused, I think, probably quite a sharp decline in S&P support in what has been a bastion of S&P of S&P support. So and Shell pulling out of Cambo has been again bemused people in Scotland that we should import rather than produce our own gas and oil. So it's an interesting situation, this whole ESG debate on energy. It's very much focused on supply side rather than tackling the demand side, because until we look at demand side, the supply side, supply is going to be there. So it's interesting, but you're right, they're making great profits at the moment.
Well, it's extraordinary. I was just going to say, sorry, if you look around the world, the cheapest sector in the world by far is the oil and gas sector.
Yeah.
I mean, it's trading at over 55% discount to its normal to the market, and it's a level it's never been at before. And I would concur with Martin. I think actually, if you look at the iron ore price, coming back to the idea of these commodity companies throwing off a ton of cash, I mean, Martin probably knows better, but they generally get it out of the ground for about $20-30, and iron ore's trading at 100 plus. Yeah. And of course, we got a monetary easing cycle just begun in China, the big user of iron ore. So this is very good news for that price. I'd say that's underpinned, and those stocks are going to throw off even more cash. So we are in a world of commodities generally doing well. I mean, it's not all doing well at the same time. There's oil has a phase, then copper has a phase, and iron ore has a phase. But I certainly think that's an interesting place.
Copper looks,
let's
copper looks
put
an interesting
put-
market.
Just
let's
let
put
Martin,
ESG
just let Martin finish, please.
Sorry, Martin.
No, I was just going to say copper is an interesting market because of the demand and the Teslas
EVs,
well can't
EVs.
get enough.
It's this
EVs.
thing, it's just to finish, sorry, it's this thing they call greenflation. This is one of the themes in markets. As we green up the world, you get inflation, as Martin was alluding to, through commodities having to be, got out the ground in a regulatory green fashion that makes them more expensive. The EV point, as you say, and commodities in general, as you change the infrastructure to make it more green, all of that is good for commodities, basically. And then, of course, on top, you're getting those supply shocks that Martin was alluding to, with spikes in prices in natural gas because of the structure of our energy market, and no longer exploring for oil and gas as we were, and that sort of stuff. So it's a big thing.
Justin.
Yeah, well, let's put ESG into its right position here. It's easy to sense of a lovely fashion fad that it has to be measured by it. No, companies are having to adopt policies which are going to show that they are operating in the right way, proper governance, all those sort of things. Motherhood and apple pie, that's fine. That does not mean they stop doing their business. That does not mean you don't have oil and miners and all those other bits and pieces. That is just used as an excuse, possibly just to try and for people not to buy those things. Look at the underlying operation of the economy. These businesses are essential. The fact they actually have to make sure they're operating in the right way and behaving well in terms of governance and things like that is fine. So they should. But that does not necessarily mean to sit there and say, "These are pariah, we mustn't go anywhere near." That's just dumb. And so investors should make use of that. A lot of these are long-term holds where throwing off some lovely income on that, compounding of that going through as part of your portfolio is lovely stuff to see. So you don't need to be terribly clever on this one. And so if you're not so picky of your investor, you just want to go for some sectors, some great companies there with a broad range of commodities. They're not all going to be shooting at the same time, but the margins there are looking pretty good. And that to me is a key area, which for the next quarter, I want to see more emphasis on.
Just on that one, I mean, it's obviously, it's quite easy to say, it's effectively no-brainer, the mining and the commodity sectors. But Martin, just on effectively on that area, what would happen, and this is a bit of an unknown sort of stuff, if the governments across the world, your COP26 at Glasgow, I know they didn't agree on much, but let's just say they might do occasionally, and they start nailing any company that is conceived as or is perceived as basically generating carbon emissions to have their fair share of greenhouse gas emissions, and to start paying for all the damage in terms of the hurricanes. If that was something of a direction of travel, then you could probably see one of the actual areas, the miners, being hit badly.
Yeah, I mean, you're right. The reason it's not going to happen is that India and China can't afford for it to happen. So hence the failure. Hence the reason COP26 didn't sign the agreement that the UK wanted. So at the moment, you guys know as well as I do, China and India are saying, listen, we can't afford to move to other forms of producing electricity, producing heat, and their populations are growing. They're wanting electricity. So we're in a tricky position, I think, in those two countries.
Okay, now
I was going to say, I wonder if a bit of a backdoor theme on this is to play more nuclear. I think nuclear is making a comeback. And of course, we've seen that with uranium, and actually we've seen that with the announcement from Boris Johnson's government of investing in mini nuclear substations. Yeah. So
it's the only way to go.
I think nuclear is a fascinating story. It's one of the big cock-ups that Merkel made was to shut down nuclear, almost as a knee-jerk reaction.
Yeah,
politicians do it regularly. Now, just
short-term popular decisions.
Yeah. Now, just changing the direction of travel. Banks, Chris, what's your view? Last time I spoke to you, you were really positive on the financials.
Yeah, I love the banks. I think they're great. I mean, what more could you want? Very heavily capitalized banks, house prices going up, lending starting to pick up. The appetite for consumer lending in the UK is about the highest it's ever been, according to the Bank of England's credit conditions survey that came out earlier this week. So, if you look at UK consumer credit, it was about 16% of GDP in 2005 when it peaked. It's now about 8%. So in other words, there's massive balance sheet capacity in the West for households to borrow. And that really is primarily how most banks make their money. So it's, I think it's a fabulous environment. I think as we come out of the pandemic, and if Omicron really does mean we're going to an endemic, goodness me, people are going to be spending money hand over fist, I think, and they're going to be borrowing to do that. So yeah, Western European banks are cheap. US banks are not as cheap, but I think they've all got a good following wind. I think it's a great place to put money.
Just look on the commercial banking side, both the investment banking side. Chris, you're absolutely right. Let me just add one other bit to it. Rising interest rates for them is good news because when they start getting below one, they can't make money on this. It's really thin stuff, so they have to try and find fee charging areas, which is why they all started piling into wealth management and things. So I think that's an easy route out. They'll cock it up again as they did last time. But no, when you've got these rising rates for core commercial banks, that's a nice background to have. So I think that people should be look at the sort of banks, even domestic ones in the UK. We've got two pretty good choices there of Lloyds and Barclays.
Yeah, that actually, I was going to say, in fact, Wells Fargo today said their net interest margins over in the States, a classic commercial bank like Lloyds and the rest of them, were 7 basis points better than they thought they would be. And of course, that's a steeper yield curve makes life a bit easier for them.
You're going to be my go-to provider of unknown unknowns, Martin. So apologies. On the banking sector, given you have got insight and you're right, the sort of the coalface of Revolut, what's the sort of like the charge of the fintech boys into the banking sector sort of taking? Just big picture. I know you can't talk about anything specific.
It's still small at the moment, but growing very rapidly. I mean, I liken the banking sector at the moment to the telecom sector, where people of our generation had a fixed telephone line, and then we have a mobile. The generation below us don't have a fixed telephone line. They only have a mobile phone. They've no intention of having it, and it's a bit like us. We have our traditional bank, and we might have a Revolut or a Monzo or a Starling account. The younger generation, a lot of them are just going to have the Revolut, Monzo, Starling sort of bank account. So I think it's a challenge for the banks. But as Chris said, the banks are heavily capitalized. They're dead safe now. They're what we want. Utilities, safe utilities, paying decent dividends, and they've got a great customer base. I mean, there's Lloyds with what, 1 in 3 people in the UK they touch. So it's going to be really a great investment going forward, as are the fintechs as well, because they're going to take market share in the profitable areas like interchange for using your credit card overseas. These are the areas they're really concentrating on, and they're going to build market share in SME lending, because you'd be surprised what percentage of a bank's balance sheet is actually lent to SMEs. I think if you did a poll of the UK, people would say 50%, 60%. Some of them are at 5%. 5% of their balance sheet is SME lending. I mean, these are really small amounts for what were traditionally set up as SME lenders.
Yeah, well, it might be slightly more than that after all the bounce bank loans sort of taken by the COVID.
I'm excluding housing loans. I mean, housing loans. I'm just saying what they lend to SMEs would be sub 10%. It's really interesting. There is a real liquidity crunch for SMEs, which we shouldn't underestimate. But that will be filled by new startup banks.
Chris?
And it's going to be fascinating. Sorry, just to chip in there a second with that issue. It's a lot of the banks, anywhere we're used to run an SME book in a bank, would require actual proper knowledge and understanding of balance sheets and how corporates work. The big the big commercial banks in the UK have lost that expertise and knowledge. They try to centralize it, run it all with series of algorithms, and funnily enough, it doesn't really work very well. So interesting when you see models from the fintech and even non-fintech, well, it's Bank North just coming through, focusing specifically on the SME market, with people who really do understand, can read balance sheets, which was the definition of bank manager to be, can you actually read a balance sheet as opposed to actually just press the button on your algorithm. And they're getting a huge amount of demand, and just particularly on a regional basis rather than London. So it's an area they see where it needs more attention. You have to go through it much more. You can't just regard it as one blob of SMEs. But once you've got that expertise in there, and you know how to pick and choose which areas you want to be in, those banks will do very well indeed. It's already seeing some, actually it's quite interesting, coming across some of the old bank managers almost being brought out of retirement because they were laid off by the banks 15 years ago, because they're the ones who actually do better understand how small businesses start up and run and need to be funded.
Okay, so if we park now the oil and gas and the banking sector, because they obviously seem to be pretty good attractive areas, another high beta area that you would logically think would do well, and this is where I want to pick your brains, Chris, is obviously the leisure experience, airlines, aerospace sectors. Give us a sort of like a bird's eye view of how you see those particular sectors, which frankly have been battered by every single new wave of COVID. And given we've come through Omicron, where hopefully most people who weren't vaccinated have now been forced into vaccination because they've caught it, and there's going to be a deluge of people like myself heading to Europe for holiday next year. Give us your view on the sort of like those sort of stocks.
Yeah, I mean, they've got a few bit of legacy problems in too much debt, but I think the reality is, you look at those stocks, they did fantastically on the announcement of the vaccines in November 2020, all the way through into early 2021. And actually, by that stage, they're extremely expensive. If you look at the travel and leisure sector in the UK, it was a massive premium to where it normally was by sort of February, March, April time last year. And a bit like a lot of the cyclical stocks, they track sideways to down for 6, 9, 12 months. I think they're ready to go again. I think they're absolutely fantastically placed. We're going to an endemic. I think that's got to be your working assumption. It may prove to be wrong, but it's the most likely outcome. And therefore, we're going to be opening up. People are going to be flying. I'm going skiing. I mean, I wasn't thinking about going skiing 4 weeks ago, and I'm now thinking about going 2 or 3 times because I've got 2 years worth of catch up. So, I think it's going to be a powerful sector to be in. I think and the operating leverage will probably be quite good, and the pricing power they'll have will probably be quite good as well. So, yeah, I think it's an interesting area.
What about you?
So just to say on that, with a particular travel, the first wave we had last year was really there were companies that were actually taking action to try and cut their costs, restructure themselves. IAG was a classic example of that. Reorganizing their stewardess contracts and even the pilot ones, restructuring the fleet itself, refinancing it. And so that carried the first wave. Now, since then, actually we get to the next stage where it's now you've got these airlines looking better with less competition. Now does the business pick up? And what you're just seeing now, what Chris was highlighting was now we see the entrance of more money going through the system. Their margins are now better. And I think that's actually going to be very positive indeed. But look for the ones that have been through the reform process, painful as it may like, whatever you think about British Airways, they did do some very dynamic and dramatic work. As the Atlantic starts opening up again, they're in the perfect position.
Just on those airlines though, Justin, I mean, if you've got a sort of like we still have elevated oil prices at $80 a barrel, plus we've got sort of like extra capacity coming on, because everybody starts getting their fleet back and obviously getting their airline staff back into operation. How much pricing power are these guys going to get, and how much margin is going to be squeezed? Are they going to be able to survive? Because it is a bit of a commodity, the old airlines.
Yeah, but a lot of the weaker ones, to a great extent, have already gone, and they realised that their future was going to be extremely difficult. And so it's those that have been through that restructuring that will actually benefit from it. So do they have pricing power on particular routes where others have dropped out? Yes, they will have. And so I think that does make it an encouraging situation. Again, depends which routes you're talking about. If I'm going back to going back home to the Far East again, there's still a huge amount of competition there. So anyway, I just renew my membership loyalty to Singapore Airlines.
Oh, okay.
I was going to say, it's worth saying as well, the Atlantic route's the most important one in terms of the profits, and the UK and the US are 2 economies that are probably not going to lock down again. So they'll probably stay fully open.
Yeah. What's your view, Martin, of the sort of the health of the consumer? Are you off skiing?
Yeah. No, I've been.
Oh, okay. Davos again, but not this year.
No. It was Zermatt. It was very nice. But I agree. I mean, France reopening's massive for the leisure industry. And that Geneva route, which was crucified is gonna BA are gonna make some money there. I think BA have taken a lot of pain. They've retired a lot of older planes. They've cut a lot of staff. I think they're really in a good position. You can never underestimate Ryanair, by the way. I mean, much as traveling on it is a painful experience. He's still the best CEO in the sector by a country mile, and he's got a massive cash pile. EasyJet is not really a low cost airline any longer, but a good airline. So we've got three good choices, I think, there.
Well, there may be a fourth. What about Gilbert Air? New one, new airline. Sorry,
yeah,
just
exactly.
Only got one plane,
private
presumably.
jet travel. Private jet travel. The signatures of this world have gone through the roof because the world's rich now don't want to travel on scheduled airlines, do they? And that's not going to return for a while, which is not great news for premium. But there's very few people can afford to travel over the Atlantic privately. So, you know, BA again is the winner there, I think.
Okay, so just moving again, sort of, we've got the oil, we've got the banks, we've got the leisure stroke sort of airlines. Now, Martin, another really hot sector that has done unbelievable in 2021 is the asset management. And I know again you've got a really good sort of like insight into that particular area. How do you see that sort of sector? Is there going to be continued M&A? I mean, can you just take us through why this is happening, why so much M&A, and why it's so attractive for consolidation?
Well, the middle ground is in a difficult position because of this move from active to passive ETFs, ESG adding costs, more compliance. But also another big shift is this move from public markets to private markets. So, I mean, you may have seen TPG went public, CVC are talking about going public. All these private market fund managers are thinking, my God, we have never seen a run like this. But that's hitting the long only guys, and especially those in the middle ground. So yeah, I expect to see more consolidation. You want to be either big or small. You either want to be a boutique or you want to be massive. Those are the two areas to be. It's much nicer to be a boutique, by the way. You can have an office in the West End, you can go shopping at lunchtime, you know, great quality of life. So hence the reason boutiques, people want to work in the boutiques. I mean, boutiques is the wrong word for them. I'm really speaking about small asset managers who manage $1 billion to 10 billion, do one thing very, very well, and they're great areas for investors to put their mony. So know who your fund manager is and stick with them.
And those smaller ones have been targeting quite deliberately, upper end of the market. They're the ones who are less price sensitive. They're much more service sensitive. And it's interesting, we have with Seven, my parting gift to them was to say, right, we've got up 15 billion, still small stuff. What are you going to be? Are you going to stay as a specialist in this particular area? Or if you want to carry on down the route of being broader out, you've got to be in 50 billion in 5. And really get yourself to that sort of scale. It's easier to get into this market because all the facilities and the kit's already there for you. You can get access to all the systems, facilities you need. But actually, if you're going to grow into something which is more of a middle size, that's where you need the economies of scale. And that's why you're seeing that great consolidation going through. And some of the old brokers keep on badging them, changing their names. They're still working the wrong way around. So it's going to be the new guys coming in who will provide a slicker, better system with, of course, a younger generation who want to use the technology. And so it works both ways.
What's your, again, now moving on to another sort of sector, because I mean, obviously those ones are sort of pretty attractive. What's your sort of view on healthcare? Because you'd have thought, given where we've come from, there's massive additional spend. And I think that we can probably use the expression that's endemic now within healthcare, because we're going to need sort of like lots and lots of different treatments for many of variants and this and that and other treatments. And the amount of the speed of innovation is very, what's your sort of view on the healthcare? Because again, the analyst community is not very positive on healthcare, hence the valuations of the big corporations, the big sort of like your large cap pharma, and obviously the biotech sector are not very stretching.
I think biotech's again, small is beautiful, isn't it? You can make serious money in small companies, when they get bought by the big giants. Because I think what's shown, and especially with Glaxo to a certain extent, without having developed a vaccine, how far behind they got left, which was really interesting.
Yeah.
They show they're not that great at developing the drugs. They're better being developed in small companies, and then the big guys buying it up.
Chris?
You saw that with the Pfizer joint venture on the vaccination.
Yeah, Chris, do you have any thought of view on the sort of the longevity and the opportunities in healthcare?
Well, they must be there. I mean, it's been a theme. Healthcare has been a theme, sort of, I don't know, for 25 years because of the aging populations and all that sort of stuff, and the improvement in health. So, I mean, what I like about healthcare is the fact it is a cheap sector, as you said. It's one of the cheapest sectors in the global economy. It's really sort of been lagging for quite a while now, and it's been off people's radar. So it'll have its day. I'm not sure I'd jump on it now personally. I think I'd rather jump on more cyclical areas of the market and banks and so on. But it will have its day. Maybe in the next 12, 18 months. Maybe it just needs a little bit more underperformance. But yeah, the cheapness of the sector, I think, is an interesting point compared to where it was a few years ago.
Yeah, and the other end of the spectrum, all things technology and these sort of like the software as a service, which have actually been, again, hammered, I think, over the last 6 months. Your likes of Snowflake and even industry winners like PayPal, you know, these kind of companies, they've come off 20, 30, 40, some Peloton, even 80%. What's your sort of view on all of those sort of like supposed COVID winners in the tech scene? Have they come off sufficiently to look attractive, or just still not touch them with a barge pole?
I think what we've seen is that all the second line tech stocks, as you say, they've been hammered hard, and the reason they've been hammered hard is not just because they got overly bid up, but also because liquidity's begun to get tight. And really, you know, as central banks have introduced the idea of moving towards the end of QE and talking about rate hikes over the last 6-9 months, anything that was on the edge of the liquidity spectrum, the highly speculative stuff, you just named a whole list of it. You could slot in there lovely Cathy Wood's ARK Innovation Fund, which peaked in February last year. And the ascent of that from March 2020 is incredible, and as is the descent in the last 6-9 months. So I wouldn't go back to them. I think the market's moving away from tech. If you look at tech in aggregate, in 2015, it was one of the cheapest sectors relative to the global market, and no one liked it. As of now, it's the most expensive sector in the global market. It's trading at a 45% premium to the market. It's never been more expensive except when it was in a bubble. So you could argue it's going into more of a bubble. Sure, that wouldn't be my central case. But in aggregate, it is a sector to avoid, and every man and his dog owns it. It is about as over-owned. You try convincing someone to sell Microsoft 2 weeks ago, you would have got absolutely nowhere. I can tell you that for free. But they wish they. I bet by now they wish they had, because it's been battered for 2 weeks.
Yeah.
But no, markets have fashions, and the fashion's been tech for 5 or 6 years, and I actually think that fashion's probably done for very good macro reasons that we've been discussing a lot of in the last half hour.
Yeah, I mean, I think your case in point with likes of Apple, even, you know, it's all like an old sort of like sort of a tech company, but I think its market cap is bigger than the GDP of the UK.
Yeah.
So it just shows that it's pretty well owned. Now, Justin, and again, you've got a real specific lens into the small cap sector, given obviously what you've been doing with regionally. How are you seeing the opportunities there? Because, we've talked a lot about large cap. What about small caps?
Very varied. And it's what I find fascinating here, and I think it's a great opportunity of actually not startups, but growing businesses that have already been there for a while. You know, we all know it's like with startups, you know full well 1 in 10 might guess something. The rest you're having to guess half the time because the business doesn't have enough of a track record. Now this country particularly, we have over the past 15 years, we see the growth of startups and smaller companies, and not very well serviced in terms of financing at all. So here is an opportunity, I think, of actually providing more investment into these areas. They're often very specialized to a region. But the trouble is, quite often they're run by people who are very good at their product, but have no concept of how to do the financing or what shareholders they should have, or do they actually wish to go public at all. And so there's a huge level of education that's necessary there to try and do it. Now, if you're there able to find areas of where you've got companies like that needing the next round of funding, maybe going to a market or something like that, there is a huge amount to be done there. Traditional banks aren't going to be doing it. Private equity do some, but this is too small for private equity. And so it's that gap between about 500,000 to 15, 20 million. You're too big to be small or too small to be big. So that I think is great, because you're going to get assets there, because they're finding it difficult to try and actually raise money, actually give them a pretty good low valuation. And the reason I particularly like, forgive me, talk about my own book in terms of regionally, it's a lower cost outside London. Everything is lower. And so if you're worried about margins and things like that, go back to those areas. There's no shortage of money. There's no shortage of businesses wanting it.
Well, just on that one, Martin, in terms of no shortage of money, given obviously you've got that sort of the insight into that fund manager, what is the sort of the cost of capital? Is it if you've got rising interest rates, then obviously the small caps are going to get, if they want to raise any more money, it's going to be a skinnier level of available capital, I'm guessing.
I think there is a lot of liquidity around, but there is liquidity until there is no liquidity. It doesn't sort of just taper off. I mean, it goes from lots of liquidity to zero. So, I mean, if you do want to raise money, you've got to raise it when the money's there, which is why, you know, Nick at Revolut went last year, and when the sector was still hot. So yeah, with small caps, I encourage them, if they do need money, go when the market's still open, because it won't be open forever. But like Justin, I love the sector, UK mid small cap. I mean, there's so much value there on a stock specific basis.
Any particular stocks at all?
I mean, I just love the AIM stocks as well. I mean, but again, it's you've got to trust the fund. You've got to find a fund manager you like in that sector. It's very difficult to pick stocks, I think, because they're all very under researched and so on. So it's an area where you want to. And my colleagues at Aberdeen were really good in that sector. So my ex-colleagues at Aberdeen, I should say, were really good. So yeah, pick a fund manager in that sector and stick with them, and you can buy a few yourself. I mean, a few AIM stocks if you want, etc. Assetco, I mean, things like that.
But there's another issue here that we should be pushing for, I think, which is actually expanding that market. Remember, AIM we originally started in Glasgow, which much to the stock exchange's annoyance. But the point was a very simple mechanism of raising local money for local businesses. Nothing particularly sophisticated about that. At the moment, and we had the Hill report on company listings, we should actually be finding other ways to increase the amount of listing so that companies have more access to capital, and frankly, as investors, have more access to exciting businesses at an early stage, not just startup. So it's, again, we can actually develop our own infrastructure. You don't need government money for this. This is one thing I actually like, is actually this is something the industry could do itself. In fact, the only thing I actually want of the government, we've got EIS and SEIS and things like that. I want the letter R in front of it. So give me a regional EIS. So give people the incentive to invest locally or in those regions.
Good luck with that one, Justin. Anyway, just moving the puck along again. Chris, in terms of the unknown unknowns, what could go wrong? We've got this general thesis between us, I think, that is going to be pretty strong economic growth, 4 to 5% sort of globally. We've got healthy rising interest rates, and we believe the central banks are not going to tap the brakes so hard that it's going to cause a recession or inversion of the yield curve, etc. If that is the central scenario, then we've talked obviously, but what could go wrong?
Yeah, the could go wrong list, it's always extremely long, and one can spend hours discussing it. I mean, we touched on the geopolitics earlier, and I would totally concur. It almost, I bet you none of us or none of the people listening can point to the S&P 500 or the FTSE 100 and tell you the day that Russia invaded Crimea, or indeed invaded Ukraine last time. I mean, we absolutely had pretty much Zippo impact. So yeah, if China invades Taiwan, that would be an issue. I'd accept once in a blue moon there's a geopolitical event that really does matter. But the rule of thumb is don't worry about it. I think far more troubling is that what we're doing is the market's starting to beat up the highly speculative stuff. And as I said, it's done the second line tech stocks, it's done the meme stocks, and it's working its way in. And I think it gets to crypto pretty soon. And, you know, as someone famously said, there's what, 3 trillion worth of market cap with no value in it. And so that's a real risk. There's a lot of loss that could come through there, and a lot of negative wealth effects. But no, I don't think that's going to be the big issue this year. The big issue is no doubt, as it always is, that monetary policy has to speed up faster than the market thinks. So inflation sticks around. Central bankers really get the bit between their teeth. That, you know, bull markets are killed by tight money. As I say, I don't think that's going to happen this year, but that's definitely a key risk. China locking down cities because they have one COVID case is a real risk. They've now locking down 2 of the major ports on the coastline, and it's spreading to Beijing. So these are real concerns because they hit the global supply chain and they influence prices of goods and inflation. So these sort of things are risks. Obviously, another variant that's vicious coming back is a risk. But, you know, I think the main thing one has to focus on is liquidity. How many times have we had shocks to markets, but because liquidity is so good, the market just doesn't care? I mean, that's the real key.
Okay, so just on that liquidity, again, I'll just throw something out here, Chris, because I want to get your view. What if the Fed is forced to start running off its balance sheet in order to prevent the yield curve inverting, i.e. to sell long duration assets?
Well, I don't think it works like that. I mean, that's the popular theory that by doing that, they'll stop the inversion. I mean, the market, I think, is bigger than that. I think the bigger question is what happens if they start selling off the balance sheet full stop? You know, and by the way, if you look at when they buy bonds, yields tend to go up, not down. You know, in other words, buying bonds is monetary stimulus, selling them is monetary tightening. So if you tighten and sell bonds, you should invert the curve, not steepen it.
But it depends on what end, isn't it? Depends on what end.
Well, you can do a twist. I mean, they did a twist back in, when was it, 2012 or something, when they sold short, bought long, I think, or I forget. I think it was that way around. They did it in the 60s. But you know, I mean, I think what would worry me if they start doing quantitative tightening is that if money's starting to get too tight and the monetary system tightens up, that would be the real issue. And you can't say, Martin's right, you can't say ahead of time, but you can watch the indicators that tell you when that's coming. And that's obviously what we get up to day by day.
Yeah. What rocks do you see, Justin?
Well, it's fascinating. Media always loves bad news, doesn't it? So any of the geopolitical issues are there to scare the living daylight out of us and to give you plenty of reasons why I don't need to invest now because, frankly, the whole thing's looking too dangerous. The world is always dangerous. It always has been. And you're not investing in geopolitics. You're investing in businesses which have got a plan, which hopefully they developed over. You can see the history of how they've operated. And so it's going to be the major economic issues that are going to affect them. So what I want to be able to see from governments is, do I trust the economic policies they're coming out with? For example, if I was operating in Turkey, I'd have a serious problem there. But you know, hopefully, I don't mean the politicians, but the Treasury are in a better position to look carefully at that issue, liquidity, and to be able to use this. I mean, the benefit that QE's been a great advantage, and they can push the lever either way. And as long as they're doing that, because as soon as you start tightening up, it tightens up really quickly. And you find yourself being very arid. So my biggest concern is experience, knowledge, and the ability to act for the central bankers and the treasurers.
Okay, well, if we rely on the central bankers, then we'll just go around the horn and just sort of like go through sort of people's top 2 or 3 ideas. Martin, if we could perhaps start with you, what if you had a sort of like you know, a couple of bob to spend on the equities, where would you, other than in fund managers, where would you put your sort of cash? Any specific stocks at all? Big, small, international, UK?
I mean, I like the oils, as we said earlier. I think the miners have moved probably enough. I like ASEAN region. I still like India. Those are the very simple.
Any specific area? I mean, we're talking Shell, BP then, are we? And
yeah, probably. Yeah, I quite like Shell. It's still so solid, and safe. I quite like BP as well. I mean, if you're going to go for you go for the big guys. And then, as I say, ASEAN, I like ASEAN, the regional funds. I like India. India's still fine. Like Chris, I wouldn't go back into the techs yet. I like UK small mid cap. Those are the areas. Nothing, and choose companies that can withstand a liquidity shock. Go for strong balance sheets at the moment, because the one thing we know, there will be a liquidity shock someday, and it'll be from something we haven't predicted. I mean, it's a bit like the financial crisis, which actually we did sort of predict, but obviously COVID we didn't see coming, and that caused a liquidity shock for a short time, of course, and then people pumped money back in. So yeah.
What about you, Chris? What about sort of like potential investment ideas?
I go long China. I think China's a place to put some money. It's a beaten up market. Everyone hates it. It's been out of favor. And of course, we've got a monetary easing cycle. What I would say is it's a trade. I wouldn't fall in love with Chinese equities. There's a whole host of problems. But I think the housing market's going to turn. The monetary easing's begun. It's coming through. Housing's been ring fenced. I think that's very interesting. The other thing I think I do that's quite fun is I go short Coinbase as a play on cryptos. And I think, you know, it's just like if you looked at the meme stocks a few months ago, they had this wonderful pennant. You know, they're all at this ridiculously elevated level, wonderful pennant. They broke to the downside because liquidity at the edge, as I said, is tightening. And boy, have they moved sharply that way. Yeah, so I think short Coinbase as a play on cryptos, feeling that beginning of tightening of liquidity. And I'd go long the FTSE as well, relative to the rest of the world. And I'd also agree with Martin. I go long energy, absolutely.
What about you, Justin?
Well, certainly. I mean, you were talking about China and Japan. The problem I always have with China is you can't trust any of the financial data coming out, as Chris was implying. All the other risks of investing in China, I've always gone about in terms of actually investing in the effect of China. What does China need? And try it that way. So you're still participating in the development of the country. Put that against India. And of course, great thing about India is, you know, it has a more developed structure. It still has issues over corruption, all those other elements. But we've got something which is much more familiar to us to be able to read and understand than we have necessarily in China. So India is my one. Then I have to say, both Martin and I probably like a broken record because there's nothing else. It's home based. ASEAN, and there's one reason ASEAN. It's the rise of the Oriental consumer. And all that has changed so strongly over the past few years. Now add tourism to that as well, add the other backgrounds, the economy in terms of commodities and things like that. And it's got a level of stability, which is attracting business. Although I have to say, watching Chinese gunboats getting a little bit too close to the Malaysian peninsula does slightly concern me. But then again, that's my problem because we've got on an island in the middle of it.
Okay, well, thanks very much, gents. Absolutely brilliant insights and comments as always, and look forward again in touching base in 6 months' time.
Thank you. Fantastic.
Thanks
very
again.
much.
Gong Xi Fa Jai.